get hurt real bad. Somebody going to get hurt. Okay, so here's what we're going to do here. Since we have so many spread traders online, I thought that this would be a good deal to show. Here, 3 weeks into the position, okay, I opened it up on September 5th, okay, and by the way, I've done income method number 3 here recently with Express Scripts. That was just a few days ago, and we bulletproofed Express Scripts, okay, but I'm showing a classic example because of how it responded right before earnings. It was really exciting. Okay, so 3 weeks in, or actually 19 days in, the stock had climbed to about $100 a share, and so the put option went down to $19.80. Do you remember from the previous slide where the put option had been priced?
Was it $24.80?
Or it was $24.70.
$24.70. Okay.
Right, so it's lost $4.90 in value. Now, Mike, would it be okay if I picked your pocket and took out $4.90? I want to get a latte at Starbucks, so I'm going to take $4.90 out of your wallet. Is that all right with you?
No, I'd prefer that you'd ask first, and I'd be kind of questioning your ethics if you just took $4.90 out of my pocket.
What if at the same time I hand you a $20 bill? Would that be okay?
Now that would be a little bit better. I would be okay with that.
Okay. See, here's the thing. I'm long on the stock, and I'm also long on the put. The put has gone down $4.90. The stock has gone up nearly $20. Okay. Now, that stock going up has caused the near-term puts to drastically go down in price, but the far-out puts have only gone down a little. And so, Mike, with one commission, one spread trade here, I sell to close the January 09 puts for $19.80 and simultaneously buy to open the October 07 puts for $7.20. Now, is that a debit or a credit?
Well, that's going to give us a credit. That's going to give us a credit there of $12.60. We got $19.80, and then we had to pay $7.20, so we're still going to receive a credit here.
Okay, now, so all I've done here is first set up a married put position. Now, 3 weeks later, I'm doing a credit spread. Okay, and that credit spread is unique because I already own one of the legs, right? I'm not buying to open and selling to open. I'm selling to close and buying to open, but it's treated the same way in my Options Express account. It's just one commission. Okay, so what's happening here is I take a credit of $12.60. Now, do you recall from before that I only had $8.74 at risk?
That's right, Kurt.
Here's our new position, okay? The new picture looks like this. Actually, we'll start with the old picture. The old picture is that I bought stock, right? I also bought, whoops, there we are. I also bought a put, okay? So my total outlay is $108.74, okay? And my spread trade that I just did brings in $12.60. So my new cost basis for owning stock and a put is $96.14. But Mike, what's the strike price of that put?
Well, we actually had a question come in. You still have the $100 put, but we didn't show that on the other page there. We just mentioned that we rolled from January to October. But yes, we did keep the 100 strike put there, so we're still guaranteed to get $100 back, but we have reduced the cost basis of the position to only $96.
Not everybody gets this the first time around. Not everybody understands the first time that I show this to them. They say, well, wait, what about the loss in the put? You have to take that into account. Listen, here's the deal. I've got a put that's dropped in value from $4.90, but I'm able to purchase a near-term put that has dropped in value about $20. Okay? Does that make more sense? When I swap those two puts for each other, I still have a strike of 100, but I've taken in some income. Okay? And not everybody gets this the first time. They say, well, your accounting's off. No, go back through it and check it. Okay? Here's the deal. I have a negative at-risk amount. Mike, I've guaranteed myself a $3.86 bonus. Why? Because my initial outlay was $108.74. I did a credit spread that reduces my cost basis for the net position to $96.14, but I have the privilege of selling for $100. Okay, this is income method number 3, and when I first saw this back in 2002 and began writing about it, I had folks write in and say, "Wow, that is so cool," and I did that on an eBay position. Well, Mike, take a look here. I've got a negative at-risk amount, okay, but earnings is coming up. Okay, so I have no worries. As earnings announcement approaches, I'm bulletproof. Okay, I sent an email to my Fission subscribers. Fission is the online advisory newsletter that I do. Actually, it's a deal where folks can look over my shoulder and see what trades I'm making. Okay, and in my letter I said I know the future, which is funny because guess what? I always say that I don't know the future, and that's why I trade with a put option in place to keep myself out of trouble. Okay, I said I know the future. My future was that the morning after the earnings announcement I would be happy. Okay, and there's a couple of different possibilities. If the earnings disappointed and RIM crashed, I'd be happy because I've already arranged for a 3.55% profit. Right, I've already made it so that if I need to exercise my put, you know, Research in Motion could go down to 10 cents a share. I would be able to exercise my put and get out $100. I've already taken out $12.60. Okay, that'll be $112.60 out of a position that cost me $108.74 to put on. Okay, so that's possibility number 1. But possibility number 2 is that earnings would excite the institutional investors and that more would drive in there and pick up more shares. And that is what happened. So, Mike, I ended up selling the shares. I sold the stock for $114.74. That was a 6-week, 16.23% gain. But again, that's not what's impressive. What's impressive about this, Mike, is that I never did limit my upside potential. I took income from the stock, but never did limit my upside potential. Do you know of a strategy that limits your upside potential while you're taking income?
Well, this covered call trade will limit my upside potential as I take in income.
Right. If I had sold a covered call at the $100 strike, I would have taken in less premium and I would have capped the upside. Okay? A covered call limits your upside. If you look at this hockey stick graph, okay, they're over on the right. As the stock goes higher and higher, well, your earnings are capped. Okay, it says reward is limited, and this is accurate. I didn't make this graph. I actually kind of borrowed it from the Options Express site. It's a bullish strategy. They say that it's safer, which is interesting because the same graph goes with a naked put, and the same site calls that riskier, even though it's a parity trade. Okay, but they acknowledge that the reward is limited. On the other hand, a married put leaves the upside open. You see this hockey stick graph, Mike?
Yes.
That hockey stick is upside down, or actually, rather, it's right side up. Okay, I have a limited amount that I could possibly lose, and that's only on the outset. After making my spread trade adjustment, Mike, this black line disappeared, didn't it?
Yes, that's right.
I no longer had a break-even point. I had already taken out all this risk and still had unlimited upside. And that is what I'm here to teach. I'm here to teach that there's 10 different ways, Mike, to take money off of a stock without selling it. And most folks are still kind of stuck in the cover calls thinking. I would like to have only the cover call sellers respond to this poll, okay? And I want you to think about it before you answer, okay? Do you, Mike, what's the most common claim that we see about cover calls trading?
Well, one of the most
common. Go ahead.
Oh, I was just going to say one of the most common things that investors realize about covered call trading is that it's a sorting machine. The losers get called out. The winners get called out of your account for a small gain, but the losers stay with you possibly for an extended long period of time.
Right, but what's the claim that most of these companies make? They talk about a reliable monthly income, do they?
Yeah, I don't acknowledge that because I know it's not true, but people selling $2,500, $3,000, some even $10,000 seminar series on covered call trading will claim to make 3 to 6% per month consistently on a regular basis. Like you and I always say, it's sort of like the unicorn there, we just don't get to see it.
Yep. I'm just going to do a poll here, okay? Are you seeing this 3 to 6% monthly income based on your entire portfolio and taking into account if the stocks have gone down?